Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the No Close Show. As always, Scott Carson, excited to be here today. And today's topic, I want to talk about when is a deal too skinny to pursue? Um, and I think I get this a lot. Hey, is this a deal? Does this make sense? People email me questions, and they've run some numbers. They've taken our some of our spreadsheets, or us working through some tapes and us sending actually the raw tapes out with our formulas on it, and they're making offers on stuff. Look, if we go through a tape and we identify assets that we're going to make offers on, yeah, you can make offers on those if you want, but you got to understand the math behind the math. Because one of the questions I'm always asking people, okay, what is your money cost? If you don't know what your money costs are, that doesn't mean you make offers. All right, you got to know what your money is going to cost you. You got to have at least some people lined up to talk to that could potentially fund your deal. If you're not talking to people about funding your deals, or having a list of people, or have your own money, then you're going to get in a bad situation, having an offer accepted, people send you due diligence, and then you having to cancel your bids and walk away. And that's not a good deal to be in. I mean, that's a bad place to be without having any logical reason of why you can't fund the deal. I didn't have any money raised. Well, you got to kind of do some marketing on both. Everybody loves making offers on deals. We love the numbers about buying the stuff. But if you're scared to have those money conversations, then and you don't know what your money cost can be, then that means the deal's too skinny, right? Because you're not running on numbers. Okay. And I want to, I had a student send me a deal this weekend, and he's looking at it and he's like, is it a good deal or a bad deal? And I'm like, well, I don't know what your numbers are. Right. So he's literally texted me all of his numbers. Right. And so I'm like, okay. So he's making an offer on a first lien. There's some equity. The unpaid legal balance is 78. He's making an offer at 65. Okay. And it's still got a few months to go to foreclosure. All right. It's in about a year-long foreclosure process state. I don't know where they're at in the foreclosure process. I just know that the bar is quite a bit behind. Value is above the legal balance, right? Well, there's only really about $13,000 in there. So if he's making an offer at 65 and that's accepted, let me be specific on this. I believe it's 78. Let me just go back through the numbers here. I got it, the text pulled up that he sent me to. And he sent me the whole like BPO and the title. I'm like, I'm not going to go through that on my phone. All right. If you want to do that, make a phone call with me. All right. So the BPO value is 120,000. Okay. All right. Current UPB is 68,578. Total payoff is 78. So that's about right. Purchasing for 65. Okay. So let's go through this. Let's just say he's using his own funds. If you're using your own funds at $65,000, your money costs you zero, right? Okay. If you take it to foreclosure, and this is in Oklahoma, this is a reverse mortgage now. I recognize that it's a reverse mortgage, so the bar is not going to fight. So you're going to have two things happen. One, it's either going to sell at auction, and Oklahoma is a relatively faster foreclosure state. Does it give me the foreclosure state on here? It doesn't give me it's post judgment. Okay, so that means it's basically the judgment's been filed. It's basically probably 30 to 60 days for a foreclosure auction. Okay. So I mean, that's a pretty fast aspect. So is it worth him making an offer at 65 and then getting 78,000 at the auction if it sells at auction? That's 13,000. Now, if you're using your own money, that's a pretty good return. That's a pretty good day. All right. Now, I don't know the interior inspection of this. It's not a bad looking property from what I can tell online. It's worth, he says, Zillow gives it about 120,000 in the middle, somewhere around there. Okay. Now, if it doesn't sell at auction, now you take the property back and you have an asset worth about 120,000, right? 118, 119. But how much repairs? Now, most of these reverse mortgages do need paint, carpet, all right, and appliances in most cases. You're going to clean out, and then I don't know what the roof is in, stuff like that. So every reverse mortgage bought, the minimum we had was at least 25 grand just for a refresh, right? Some was a little bit more, some was a little bit less, but on most of the time, it's always 20 to 25. Okay. So if he's buying at 65 and it sells at auction for 78, 13,000 in just say 90 days, is that a pretty good ROI? That's a phenomenal ROI. Okay. Does it make sense to do that if he's using other people's money? Yes and no. It all depends on what that money costs are going to be. Now, an investor may not want their money being out only 90 days. Okay. And some do. Now, if you're using your own funds, by all means, that makes sense. But for me, that's probably too skinny a deal at that aspect of only making 13 grand. All right. Because you're paying $6,500 and an investor, let's say an investor wants 1 year of interest as a prepayment for the money going out. Well, 6,500, you know, at 10%, that's 6,500 bucks. You're not at 72. That's a pretty skinny deal to be that way. Now, if they want their money out for a year and you foreclose, it doesn't sell, and now you got to put money into it for the rehab, it might make sense depending on what the rehab costs. I haven't looked at the interior inspection report and stuff like that at all. So that's not so bad. Another skinny deal niche I would look at would be the P&I payments. If it's an occupied asset, look at your principal and interest payments. Now, reverse mortgages will confuse some people because it'll say it's $1. Of course, a reverse mortgage, the borrower's not making mortgage payments. Okay. They have to put something in $1 is usually what they put at. So that's separate. But when you start looking at monthly mortgage payments and you start getting to that point where they're at 400 or below, those kind of tend to be a little skinny, especially if you've got to pay out monthly, quarterly payments to your investor on money or a split of the cash flow that's coming in from getting the borrower back on track. Now, there's pros to cons. You have to decide what's too skinny. I always say that really $250 and below, if you're using your own funds, really gets to be too skinny, especially if it's non-performing and you're paying $90 a month towards a servicing company for non-performing. That's 160 bucks left over for you. That's not a lot of money coming in when you start figuring in other expenses along the way. All right. Now, if you get the bar back on track, okay, it might make sense to do that. If you modify for a higher payment, that might make sense. But if I'll give you an example, we had another student that was buying a note in Pennsylvania, and the P&I payment, he bought it with the idea that he was going to foreclose. The borrower's way behind. I think the original balance is only 50. The borrower owes over 100. Okay. Property is worth 85, something like that. He bought it at a pretty cheap price. Suddenly the borrower comes to the table, oh, I can pay some money to reinstatement. Well, or he has some funds and he wants to reinstate the loan, but he doesn't have the full amount of 130. Well, it would be a good yield based on the money that the guy told my student and supposedly said to the court that he's got to reinstate it. It would be a good ROI in year one. After year two, it gets down to below 9% ROI based on the payment stream if the guy keeps payment. Well, if the guy pays a lump sum and then stops making payments, guess what? It resets the foreclosure clock all over in Pennsylvania. You got to go through that ride again. Okay. It also, I think he's also dealing with a statute of limitation on some of the stuff that's collectible. So my student is running it. Well, do I accept a lump sum payment? It resets the statute of limitations. I can go after the full amount. But if the guy pays beyond a year, it's good for only year one, year two, year three. I'm losing money because my money costs are 10%, and it's only returning 9% at that point. I said, well, you got to figure out, you're going to have to hold some money over from that down payment to potentially pay your investor off. Now, of course, after 12 months, could you sell it as a reperforming note? Probably get 80, 90 cents a dollar of what the balance is. Yeah, you probably could potentially get that, but it's kind of a skinny deal. So that's the thing that you have to look at, is know what your money costs are and be upfront. If you're making offers and you don't have any money raised, tell me. I'm glad to give you some ideas, but you got to be coachable in going out and getting there. Going to your local real estate clubs is the first place to go. But you also need to be doing some outbound marketing to IRA investors. You also have to understand the process. It's not just a fill out investment questionnaire and that person's going to fund your deal. All right. You have to build a relationship. It takes skill. If somebody says they've got money, you still got to make them A, fill out investment questionnaire, B, get a proof of funds, C, a pledge letter, and still be talking to them about the process of going along, what is going to happen. And yes, you've got to pitch the deal. It is what it is. The networking aspect of it, the sending out letters to IRA investors. This is an ongoing process that everybody has to do. If you're not willing to do that, then I'm sorry, you're not going to get any bids accepted and you're just wasting your time. And you probably need to spend some time on the marketing side. I mean, that's what's so great about our one-on-one coaching, is helping you eliminate the skinny deals, but also helping you raise capital with your marketing, helping you raise capital with the pitch decks and stuff like that. And over the next week or two, we'll be having more some refresher videos on the pitch decks and the things like that to help you get the most out of your note investing. But when you look at how skinny deals, you've got to figure in money costs, what's coming in potentially on P&I payments, what's not coming in. I know repair costs will drive bonkers. I mean, people bonkers because they can't estimate it, but you can figure in paint, carpet, even if the interior inspection and peeking the windows looks pretty decent, that's going to probably be 20 to 25 grand, if not more, on a simple clean out and get the property ready for marketing on the MLS. Now, the property's in pristine condition, that's great. Sometimes that happens. We have had that happen where we bought a note and we didn't have to do anything on the inside. The place was completely clean. All we had to do is like put 3 or 4 bags of mulch outside to boost the curb appeal. You know what I mean? But when it comes down to everything, there's things that you're going to want to get rid of. There's assets on tapes that you want to get rid of. And that's why we have that aspect on our due diligence spreadsheet, our due diligence checklist. Start getting rid of things that are too skinny. First and foremost, you obviously can get rid of the states you want, because some states take forever to foreclose. That makes your deal very skinny with foreclosures, costs, and things like that increasing. All right. You really have to understand the market. Like right now, Florida is a great example. Florida's got a lot of defaults, a lot of stress, a lot of issues in insurance, a lot of issues with condo associations, HOA associations, stuff like that. You've got the Airbnb meltdown down there, where a lot of stuff is coming on the market and stuff's getting discounted, but it doesn't mean that discount's a good deal, because it's all about what somebody will pay for an asset, right? So that's the thing. I kind of avoid Florida right now. I mean, I keep an eye out for a few areas, stuff like that. But for the most part, Florida is just a no-go right now for a period of time till everything kind of hits bottom and it gets collected a little bit. Unless you can buy it really, really cheap, I would kind of host stuff now. Is it going to be like 2010? I don't know. But that's the thing you got to keep in mind is there's 3 things you're looking at: P&I, payment, if it gets reperforming, and then that difference between the legal balance and what you're buying it for, and then that equity above what you're paying for the note. Now, obviously, in this example I talked about earlier down in Oklahoma, 120 is quite a bit above 78. All right, that's was it 42,000, $42,000 above the legal balance. That's a lot of equity, but you don't get that equity until you take the property back. Now, is he likely to foreclose and either sell it at auction? Maybe. Would he take it back? Maybe. I would say it's a 50-50 chance he takes it back and then can sell it as an REO, or B, he sells it at auction. It's a bit of a skinny deal if he's using other people's money, and I don't know the terms of that money. If he's using his own funds, it might be a pretty way fast to make 10, 15 grand and move on. Get the money in 30 days, get it out, depending on the foreclosure process. Let's just say 90 days start to finish. And then if it doesn't sell at the auction, then you've got an REO that you could fix it. And then that's the thing you got to look at too. What are the days on market? What's the time frame in those neighborhoods? It's a very important thing, because if you start seeing assets right now where they're running beyond 120 days, 150 days, 180 days on market, that means your value, you've got to drop your value down, and that can compress your profitability, compress the equity, and turn what you thought was a pretty good deal into a medium deal or a skinny deal if you've got to move it. And that's one thing you got to look at. You've got to really expect, if you're taking property back, to fix the property up in a pretty decent condition, almost like move-in ready in a lot of cases. A lot of buyers don't want to be, especially new home buyers, especially as we get through the summer here, don't want to be looking at heavy rehabs. Yes, there's a little bit of minor rehab, maybe change up some paint, tweak up the carpet, some fixtures, stuff like that. But you really need to have the property ready to rock and roll and move it ready to get the best price for your asset and get the best possible outcome of getting that asset moved. And that comes from talking to your realtor, and your realtor understand what's going on with the property. If you listen to the previous episode with Cal Ewing talking about his 100K profit, one of the most things that made that deal marketable the most is curb looks good. I mean, those properties have huge shrubs, I know, because I was there. So curb appeal was nice, and he did a lot with new carpet, new paint, new appliances, and a good clean out job, and that helped out dramatically. And there's also some nice little features too in that from the previous owner had some nice light fixtures, had some nice like light switch plates, were all upgraded light switch plates, little things that add to it that were pretty nice, with sconces, some nicer ceiling fans than normal. So that helped out. Plus, it was also, you had a used fridge that was clean. You had a new stove, new dishwasher, new disposal, existing washer dryer that would add to it. So that really helped move that market. So it was actually, you could move in ready and be rock and roll. And that helped. I think it helped move it within 9 days and getting it a full price, basically a full price offer. It could have gone a little bit higher, but it probably would have dragged things out. So that's the thing you got to understand too. Looking at that days on markets, not just looking at an AVM, but talking to a realtor, what's it look like, and then just determining your numbers. Is making 15 grand good for you? Yes. Me, I like to make 20 just because you have uh-ohs. There's always hiccups along the way, things that take a little bit longer, things that pop up that you might have to replace. Okay. Um, like I'll give you, even Cal talked about that, a $17,000 roof cost. Luckily it was already on the MLS. Luckily he had a connection that was able to put that 17 grand on the HUD and it was payable at closing. He didn't have to come out of pocket for the 17 grand to make things happen. And so that's some stuff you got to look at too. And I get it. You're not going to know interior repairs. You're not going to know everything with being a vacant asset or even an occupied asset to get into. But if it's occupied, you can kind of take some thought and hey, everything should be running pretty good inside the house, right? But you're gonna have some clean out costs and stuff like that. But look at those numbers. I like to be at 20 plus or more on a foreclosure. That way it gives me a little bit aha nuggets, even if so I'm getting a little bit cheaper price. So like I'll give you on this example, I would want to be at 58 versus 65. Now, could I meet in the middle? Yeah, I could ask for that meet in the middle. Could we get done maybe at 60? Yeah, that's better. The little bit, 1,000 go a long way. 1,000 is your basically appliance budget because stoves and dishwashers are not cheap. Like an average dishwasher is 400. The average stove is about 600 these days. It's crazy how expensive a lot of appliances are getting. So look at that stuff. Once again, look at your P&I payment. Look at the difference between what you're buying the note for and the legal balance. And then also looking at the difference between if there is equity above the legal balance or there's a big enough chunk of profit between what you're paying for that note and then what 90% of value is. Because 90% of value, remember, you still got closing costs and commissions that come out. So at 120, if he sells it at 120, he's going to net 108. And that still could be pretty good. But keep that in mind. Knowing what your market is, talking with realtors, looking at BPOs, looking at inspection reports, that's the big things. For some people, 50 grand is too skinny. It's not worth their time to anything less than 50 grand. They've got more money. They want their money moving. And we all kind of move up that level, depending on where you're at money-wise. Okay? And that's the thing. I had one guy out of New York, I don't get out of bed unless I'm making 50 grand. Like, okay, that's fine. There's plenty of people that do the deal for below 50 grand. So know where you're at. Get started. Do something. Pull the trigger. Get something accepted. Get something working through, but know your numbers. If you don't know your numbers, I mean all your numbers, what the profit is, if it does turn into reperforming, does it make sense to do that? To keep it, to work with a borrower or not work with a borrower? All right, I got another student that had a non-performing note in Houston. Borrower hadn't paid in a couple years. Out of the blue, he offered the borrower 25 grand. If they brought 25 grand to the table, he'd modify. Well, lo and behold, she brought 25 grand to the table and he's kicking himself. I'm like, you should have just said, you got to bring the full amount due. I know you want to have a heart and you want to be friendly with this person, but that's the problem talking to borrowers sometimes is you agree to things that you probably shouldn't do because you want to be nice, but you got to run a business. And now that deal is a skinny deal for him if it runs beyond 12 months. So hopefully that was helpful for you guys. Understand your spreadsheets you're looking at. And as always, if you have any questions, please don't hesitate to reach out to me at talkwithscottcarson.com. Our next 3-day note buying workshop is upcoming July 25th through the 27th. You can get signed up for that at notebuyingfordummies.com. And as always, if you're looking to take your note investing business to the next level, hey, feel free to reach out to me. Let's talk about our one-on-one coaching programs. We've got the best in the business because we have the most amount of success, highest amount of success rate with our students because we show you how to actually close deals, not just talk notes. All right. It's much more different closing deals versus being educated and talking theory. And part of it is I'm going to kick your butt and boost you along with my butt to make you banking offers. You could be the most educated idiot out there, but if you're not closing on deals or haven't closed on deals or just talking about notes, what are you really doing? All right. So go take some action, buddy. Love you all. Have a great day. And we look forward to seeing you all at the top. Bye, everybody.
Hey, my name is Cal Ewing. I live in Calgary, Canada, but I've been investing in U.S. real estate, residential real estate, since 2009. And in the past 3 or 4 years, I got into the note investing space, both performing and non-performing notes. And I discovered Scott Carson and his trainings, his mentorship, his note weekends, and his one-on-one coaching. And through Scott's incredible mentorship and guidance, I just completed the biggest deal of my 16-year real estate career. I bought a non-performing mortgage note in Texas. We negotiated a deed in lieu of foreclosure with the borrower, and we did a light rehab and ended up selling it and made a 70+% annualized return, $116,000 profit before taxes. So I wanted to share my enthusiasm with working with Scott and my gratitude for all of Scott's help, all the things I learned from him and his program and his guidance. I couldn't have done it without you, Scott, so thank you so much. And if you're out there looking to maybe jump into one of Scott's note weekends or get his one-on-one coaching, I felt that it is worth every penny, and this deal proves it. So if you're on the fence about it, these kind of deals are possible if you just listen to Scott and his advice and you take action. Thanks, Scott.